India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning, you're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleagues Surabhi and Mangalam. Guys, good morning.
Good morning.
Good morning.
So we're talking about the market cues and, the start likely to be in the green, etc. That's about later. Prashant, wish you a very, very happy birthday. Another round around the sun, and may you keep being healthy, wealthy, wiser, prosperous, and more importantly, happier.
Thank you so much, Mangalam.
Many happy returns of the day. And viewers, if you're wondering why there was this little awkward pause at the start of the show, that's because we were trying to corner Prashant into getting us a party. So that conversation is going to continue off and on air. But wish you a fantastic day and fantastic year.
Thank you so much, Surabhi. As my wife says, closer to 50 than I am to, actually 35. So I think, but yeah.
We freeze at 35, don't we?
We do?
Okay.
Some do, not all.
I don't know what 35 is.
Yeah, of course.
So, since you're closer to 50, you'll raise the bat at the half-century mark?
Not
Not
yet.
right
Not
now,
yet.
not
Not
right
yet.
now.
Closer to 50, not there. All right, well, let's kick off market action and what you need to know as we begin another trading session here. You basically have another decent day as far as Wall Street is concerned. The rally started last week and it is continuing. And the markets overnight are giving us good cues. The S&P ending about 1% higher, the Nasdaq ending about 1.4% up. The S&P is now just about 1% away from the pre-jobs data sell-off levels. That's quite incredible, isn't it? And it's coming fast and furious. 11 sectors, all 11 S&P sectors were higher. 82% of the stocks which traded were in the green. I'm just sort of highlighting some of the finer data points here in terms of what happened in the US market, just to say that it was not just 7 stocks on the Nasdaq which did the job. It was a broad-based move after the sell-off that we've seen, 1.5 odd weeks ago. Of course, it helped that there was no real sort of souring headlines or risk events or bad data, etc. Dollar index, and that's the big one, right? The dollar is continuously selling off. It's below the psychological 102 handle. We left off at 101.87. So day before yesterday, 0.6% sell-off, another 0.5% yesterday overnight. And that gets us to under 102. Treasuries consolidated. The 10-year yield is down about 1 basis point. Curves, longer end flattened. And by the way, the other data point, which is the USD JPY, that is calming down as well. The dollar is depreciating. The yen actually is now back to about 146.6 from 145 levels. The high was about 142. It moved from 162 to 142. It's now come back, not quite there, but we are getting there. 146.6 is where we are at. Oil prices sold off sharply, and that is the bigger move actually out of everything which happened overnight. 2.5% lower, and we are now under $78 per barrel mark. It's not a bad setup at all. I mean, equities are higher, dollar is sharply down, yields are flattish, oil is down sharply. I mean, I think it's a good setup to wake up to if you're thinking about going long and looking at upside levels. And that gets us to where we left off here and the levels. So the Nifty consolidated. It was a quieter session, but I mean, of course, you're coming off the 400-point Friday rally. The small caps rally, the small cap index was just about under 2% higher. So bulk of the price action was in small and mid caps, and that did very, very well. Near-term hurdle for the Nifty, and I think we should get that done today, is 24,686. Yesterday's high was 24,640, 38 to be precise. So we never got to the 686 level. What is that? It is the upper end of the gap area, which was caused by that global sell-off. And it also coincides with the 66% retracement of the fall that we've seen. Now, closing decisively above the 24,686 level, this level, can take us towards the all-time high of 24,078 and beyond. But you need a decisive close above it, and then we'll talk about higher levels therein. Bank Nifty has been the weaker of the two indices. And by the way, supports, same 24,100 where the market has found, reasonable amount of buying coming in over the last 10 days or so. I don't think that should come into view today. Nifty Bank needs to take out the 20-day moving average and the swing high. Both are the same now, by the way, which is 50,830 as of yesterday's close. And again, here also, I mean, looking at global cues, etc., maybe we take a shot at it. We'll see. Support for the Nifty should come in around the lows of support for the Bank Nifty on the downside should come in at about 49,654, which must be defended. The GIFT Nifty will come up on your screen, and that should give you a sense of how we are starting, 50 points higher. So, a slower but higher start is preferable, and then you sort of build on it instead of a big gap up, which then makes it all the more difficult for newer people to come in and buy on top of a 100, 150 odd point gap up. So this is fine, and hopefully we're able to get over that 24,686 hump and then maybe look beyond as well. So it's not a bad looking global screen, as I said, Surabhi.
And your shirt is matching the sentiment, I think, Prashant, with all the green.
Shirt and tie.
but yeah, as you said, probably slow and steady wins the race, they say. So if we kind of start gradually and then build on it, traders will take that with both hands, because the setup has been very, very positive. I mean, we've got Wall Street with 8 consecutive days of gains, at least the 2 indices. That's the S&P and the NASDAQ. Big moves coming in over there. By the way, the only chatter that I'm sure Wall Street will start sort of, looking at as well, political chatter, is Kamala Harris talking about an increase in the corporate, tax rate, and a big increase and a big rollback from the Trump era cut. She's now saying corporate taxes should be at 28%. Trump had slashed the rate down from 35% to 21%. So a lot of the political chatter will, of course, keep Wall Street occupied, along with all the, action around central banks. Speaking of central banks, here in Asia, China has been in step with expectations. That they haven't touched the loan prime rate at all. It's been left unchanged this morning. So no hiccups there. And some of the key markets like Japan continue to build on to the momentum. Japan is up another 2% this morning. So that's good news. Of course, there's a lot of dilly-dallying over the extent of the cuts that we may get from the Fed in September. And later, this morning, if you look at the Fed Watch tool, the probability of a 50 basis points cut is reduced quite a bit, considerably, to about, I think, just about 50% right now. So let's see how that plays along. Now, the fund flow picture here, again, FIIs went back on the sell side yesterday. Remember, just a day prior, we were talking about a minor buy of about 700 odd crores. Well, that reversed again yesterday, and the selling was to the extent of 2,600 odd crores. Domestic institutions or buyers, about 1,800 crores. Pull up the FII stats for the last couple of months, and we've turned negative all over again. So the number was negative in May, around 25,500 odd crores. June and July were positive. August, we've rolled back to a negative net number. This is the final number, not the provisional, the final number that comes in. So we are at negative 20,000 crores from the FII fraternity. But hey, we've got a great DII support coming through. So not much of a problem. But again, just to place this on record. In terms of corporate action today, actually more than corporate, market buying, selling action. Zomato is going to be the stock on my radar for sure, because there's a lot of buzz that Antfin is looking to pare down a little bit of its stake, between 1.5% to about 2%. So let's see demand. The stock has been on a massive tear. And the sense is that, any dips will probably get snapped up, because, there's a lot of, shall I say, hunger for Zomato on the street. Mangalam.
Well, hunger and lack of patience. People really are seeking a fair amount of convenience in the quick commerce business. And there is a fair amount of demand because, the size has been up. But more on Zomato in just a bit. For our markets itself, there are a couple of things that I'm looking at. Yes, it is likely to open fairly strong, but where does it close? That's extremely crucial to track. Why is that? Because yesterday's open and high on the Nifty were absolutely at the same level. The Nifty managed to hold on to some green, the sensex a bit of red. That's because the financials are under a wee bit of pressure. You have, both the Nifty Bank as well as the Nifty Financial Services, which were about 0.25% lower. Broader markets, no problem. We were talking about, 82% of S&P 500 stocks doing extremely well. But our markets as well saw great gains. In fact, the Nifty Next 50, which is a barometer of where, good quality mid-caps are, that was up almost 0.6% in yesterday's trading session itself. What is it that dragged the markets lower? Yes, on the FII selling front, there was selling, but there wasn't enough buying by the DIIs, and as a result of which the net flows were, a sale of close to around 900 odd crores. The FIIs bought in index futures the previous trading session. Then again, yesterday sold about 304 crores. The net long contracts, short contracts exposure moving to around 50% each itself, with the net exposure now closer to around 350 odd contracts on the short side. Basically, absolutely at an even keel. The 24,600 mark seems to be a bit of a fulcrum for the Nifty. 24,600 call and 24,600 put both of them fairly active. So, putting the option-based range on the Nifty at the lower level to close to around 475, and on the way up, 24,700 is something that we're looking at. And this ties in with the technicals of the market as well, where the 20-day moving average of the Nifty is 24,480. And the 20-day is important for both the Nifty as well as the Nifty Bank. For the Nifty, it is an important support. For the Nifty Bank, it is a crucial resistance. Yesterday's high on the Nifty Bank as well was closer to that 50,828 mark itself. What can move the needle? In the second half of trade, watching out for HDFC Bank in particular. Why? Because it defended the 20-day moving average yesterday. On the way up, it's the 50-day moving average that we will keep an eye out on. This is the highest weight on the Nifty Bank and on the Nifty Financial Services Index, along with the Nifty as well. So the Nifty Financial Services expiry plays out today. It's a Tuesday, so we'll watch out for that as well.
Mangalam, thank you very much for that. So that's essentially a nice wrap out of what you need to watch out for in terms of specific levels and the markets overall. Let's get in some perspective. We have Mark Giannoni, is Chief US Economist at Barclays. He's with us in the program. Mark, great to have you with us here. Thank you for your time. It looks like all those sort of fears about a US recession, etc., behind. And last week we had that. Once again, that so-called Goldilocks kind of data, which the market has latched on to. And if you look at US stocks, it does seem like we're not in the phase of short covering anymore. There are fresh longs being added. So you're in, once again, would you agree, in a bit of a risk-on kind of a zone? What's the perspective, Mark?
Yes, again, thanks for having me, and good morning, happy birthday. So last week's retail sales, I think, have been quite important. They suggest really that the spending part of the dynamic that has been driving the economy, and in particular the cycle between employment, the income that gets distributed, and then the household spending. That cycle keeps going. And there were some concerns a couple of weeks ago when the payroll report came out that was about to break. We didn't think so. We thought that the fundamentals really for the households in the US economy are still strong. If you look at income, if you look at household net worth, and that the economy can continue to power through.
Mark, hi. Good morning. So, just about 2 weeks back, everyone was fretting about a hard landing in the US, and now data is looking like, maybe it won't be that bad. What is the extent of rate cuts that you're penciling in from the Federal Reserve, and the way you see risk assets respond to the current macro setup?
Yes, so on the Fed, our expectation is for the Fed to see that there is some slowing taking place. The economy is no longer growing as rapidly as it was in the second half of last year, necessarily at the beginning of this year as well, that we see the labor market gradually cool. And with that, inflation has also come down. And it has come down to a point where the Fed is comfortable now about starting to cut rate. Our expectation is that the Fed will cut 3 times 25 basis points this year, first in September, then another 25 basis point cut in November, and then a third basis point cut, 25 basis point cut in December as well. So that's our expectation for this year. As far as equities are concerned, they'll benefit from a slightly lower rate, and they benefit from that. They also benefit from a pretty resilient growth. So going forward, we expect the economy to remain resilient, to not enter into a recession, but to really gradually slow to the long run steady state growth path that the Fed has been trying to engineer, and the soft landing it has tried to engineer. So we are pretty optimistic on that.
Right, 3 rate cuts with a soft landing, positive for equities. But, before the Fed meet, the near-term imponderable will be what we hear from the Jackson Hole Symposium. What are your expectations from there? What is it that you think Jay Powell would say or should say?
Right. So we think that the Jay Powell will give an important speech on Friday here, 10 Eastern Standard Time, Friday morning. The our expectation is that he will express more confidence that conditions are really in place for a 25 basis point cut at the September meeting, provided still that inflation remains moderate and the labor market conditions remain unchanged. We strongly doubt he will make any policy commitment, like we think he will likely reiterate that decisions are going to be data dependent. They are also going to be made on a meeting by meeting basis. But we also think that Powell will mention that the FOMC is prepared to respond forcefully if the labor market were to unexpectedly weaken. So our expectation again is baseline scenario, he's going to open the door for this 25 basis point cut. He'll express confidence about that, but be open to the possibility of having to cut more if conditions were to really unexpectedly weaken.
All right, Mark, we'll leave it there. Thank you very much for your time here on CNBC TV18. Thanks for the wishes earlier. Appreciate you joining us here this morning. Well, that's Barclays with a perspective, so no recession. I mean, I think that is a thing of the past. We're back to talking about as we were from the middle of last week, Goldilocks. We'll run you through some more opinion that we are getting. Mahesh Nandurkar of Jefferies also weighs in, and he says that the 12% earnings growth for the Jefferies coverage universe, this is excluding oil and gas and metals, for domestic companies was broadly in line, though analysts at Jefferies are downgrading their both FY25 and FY26 earnings for more stocks than upgrades. So the overall season was a tad disappointing according to him. He says the June quarter season was impacted by a harsh summer and elections in select sectors. Employee cost growth weakening to 5% is a negative, according to Mahesh. And he adds that consensus Nifty EPS for FY25 is unchanged with growth estimates at 16%. And the key positives were improvement in IT and rural commentary.
All right, let's move to some money market views. Abhishek Goenka of India FX and Asset Management says fears of a U.S. recession have been allayed, post better than expected U.S. retail sales data and upbeat consumer sentiment. He says probability of a 50 basis points cut in September has come down, and also adds that U.S. Treasury yields have stabilized and the dollar is weaker against major currencies and crude prices are also lower. He adds that the USD-INR pair continues to remain extremely stable and he expects it to continue to underperform amid broad-based dollar weakness. He says the Fed Chair Powell's speech at Jackson Hole will be a key event to watch this week, and he's expecting the rupee to trade in a range of 83.40 to 84.40 over the medium term.
All right, on bonds, we have B. Prasanna who weighs in. He says that ICICI Bank global fixed income markets remain in a consolidative mode. He says incoming data has surged recession fears in U.S., resulting in less aggressive rate cut expectations. Back home, he adds NPC's continued focus on inflation and upbeat growth indicators have kept rate cut expectations at bay. And he's expecting markets to trade with a softening bias given robust demand for bonds. The 10-year bond yield, according to him, is likely to be between 6.85 and 6.9%.
All right, we have a lot of stock-specific action to track today as well, and we'll get to it in just a bit in our special Top 10 segment. Today, we're looking at a bunch of stocks: IndusInd Bank, Nucleus Software, High-Tech Pipes, and Sequence Scientific on our radar on the back of positive news flow. Then we have the big block deal in Zomato, Bajaj Auto, HCL Tech, Zaggle Prepaid, Prudent Corporate Advisory, and Poly Medicure stocks, which may see some bit of red in today's trading session.
Right, well, on that note, we'll take a very quick break. We'll come back with a list of potential top movers and shakers, a stock list coming up in just a bit. Welcome back. So the cues are quite positive. Let's look at the stocks that could be in focus today. That's the implied open with the GIFT Nifty. Most of the Asian markets are showing lots of green, barring mainland China as well as Hong Kong. So let's talk stocks. As promised, we have our team standing by with the list this morning. Guys, okay, we've got everybody on the same window now. Manglam, you go first. Zomato in focus yet again. Tell us more about this potential block.
Well, so if you look at Zomato, yesterday there were good pieces of news coming in. The stock was doing extremely well, but it ended in the red after hitting a record high. So nearly 7% of highs. That's about 1 month. But just yesterday's chart should tell you that, the stock was seeing or sensing some sort of supply coming in after the big move that we saw already. And now we have news on that as well. These are sources telling Nimesh that Antfin will sell 2% stake in the company for nearly $556 million. Remember, there is a fair amount of demand for that, which is why the offer size has been increased from 1.5% equity earlier as of last evening to about 2% now itself. The floor price is at 251.6, which is a 4% discount to yesterday's close. And which is why I'm going with a red, largely because the deal would be done at that. There would be an adjustment for it. Thereafter, the stock would perhaps see a recovery given the sort of momentum that it's seen already. The only thing that we'll have to watch out for now is that are they looking at a clean out at some point in time? Because right now they are selling 2%. They hold about 4.24% stake as well. So at some point, they would like to sell the other 2.24% as well. Puts a bit of a supply overhang, but nothing fundamentally wrong.
Absolutely. And we had Ramdev Agarwal yesterday with us.
He said they've started trimming stake as well.
They've at least trimmed significantly.
Yes.
But he said, to be sure, they bought under 100 rupees.
Yeah.
And they want to sort of realign the portfolio a little bit. But it just shows you that early investors, this is a buoyant market. I mean, if you don't sell now, if you want to sell, if you don't sell now, when do you do it? So, and funds, of course, can sell for a variety of reasons. It's not always necessarily, a call that, well, the business has turned south or whatever. It's not the case. And I think Mr. Agarwal, of course, made that case very pointedly. IndusInd Bank is the next one we were focusing on. Abhishek has got details here. Abhishek, good morning.
Good morning, Prashant. So, IndusInd Bank has given a press release wherein they mentioned that the bank has received approval from RBI to set up a wholly owned asset management business of a mutual fund. So, this is to be done via equity infusion or infusion of equity capital into that AMC business. There are additional conditions which are mentioned in the letter. Remember that sometime back, the promoter group, that is Hinduja Group, had picked up a 60% stake in Invesco. So, Nomura has written a note on IndusInd Bank. They have a neutral rating with a target price of 1,580 per share. They say that this is a positive development for the bank that currently does not have any direct para-banking subsidiary businesses. Back to you.
Right,
Okay.
Abhishek.
All right, Abhishek, thanks very much. So let's see, perhaps one more mutual fund house coming soon to the street. Let's quickly move on and talk about Bajaj Auto. Sudarshan's watching out for this one. What's the news here, Sudarshan?
Morning, Survi. So for Bajaj Auto, I'm going with red just because company will see one-time impact in its net profit in the Q2 period. So the news is company will provide for rupees 211 crore in Q2 as indexation benefit is withdrawn on debt mutual fund long-term capital gains. So what will be the impact on P&L? Company says provision for this one-time impact will be made in the net profit, and impact of one-time change relates to other income and not the operating performance. Also, only a provision is being made in the books of accounts at this point. Actual tax payment will be made at the time of redemption of these mutual funds. So what are the reasons of these additional provisions that company is going to make in Q2? Company invests surplus funds into several asset classes, including debt mutual funds. It used to make provisions for deferred tax on fair value gains on these investments. Remember, in budget, Finance Minister announced withdrawal of indexation benefit on LTCG on debt mutual funds purchased before April 1, 2023, and also announced change in the tax rate from 20% to 12.5% without indexation from 20% with indexation. And this is the reason that these auto companies are going to make additional provisions in Q2.
All right, Sudarshan, thanks a lot for that. A mild red is what you see on Bajaj Auto as well. The stock ended about 1.2% lower in yesterday's session already. It was similar to what Maruti had said in yesterday's session as well. Stock ended about 0.5% lower too. But let's go across to Rima now. Rima's got news from the tech space. Rima, HCL Tech and Nucleus Software.
Yes, so let me start with HCL Tech, where the CFO Prateek Agarwal will be stepping down to pursue opportunities outside of the company. The company has appointed Shiv Walia as the CFO effective 6th of September. Shiv Walia has been, with the company for over 3 decades now. He started his professional career, so an insider, and he will take on the role of the CFO's position at HCL Tech. Nucleus Software is the other mid-cap IT company I'll be watching. Board meet on the 22nd of this month, where they will consider a buyback of shares. The cash in the company's books as of 30th June was 920 crores. Back to you.
All right, thanks very much, Reema, for that. Well, Zaggle Prepaid is the other one we want to talk about here. Also, by the way, there was a block. Prudent Corporate Advisory was down sharply yesterday, and there is that one we want to cover as well. Vivek has got both those. Vivek, morning.
Well, good morning. Both of these stocks actually saw large trades in yesterday's trading session. Let's go with Zaggle first. Zaggle, again, what's actually happened here, one strategic investor, Zuzu Corporate Software Services, sold close to 4% stake at 361 rupees a share. Now, remember, they held close to 12.83% stake, so now there remains an overhang of further trimming of stake. Now, when you're talking about Prudent Corporate Advisory, again, close to 2.5% of total, 3.5% of total equity actually exchanged hands yesterday. Two of the promoters, which is Sanjay Shah, sold close to 1% of the total 43.3% stake that he held in the company, and another promoter, Ramesh Chandra Shah, sold close to its entire 1.48% stake. Amongst the buyers, the ones that have been disclosed is Societe Generale. They purchased close to 0.7% stake, going with the red on the back of the strategic investor and the promoter selling stake in both these companies.
All right, got that. Thanks, Vivek, very much for that. Back to Abhishek. Abhishek, you're looking at Poly Medicure. What's the development here?
Well, sources tell that Poly Medicure has launched a QIP. The QIP size is about 1,000 crore, and the indicative price that they have set is at 1,850 per share to 1,880 per share. So the discount is about 11.5% to yesterday's closing price, and to SEBI floor price, it's almost at the similar level. Equity dilution would be about 5.5% to QIP equity base that they have. The use of proceeds states that funding capital expenditure to be incurred, a company for setting up manufacturing facilities, pursuing inorganic opportunities and general corporate purpose. So there is a 90 days lock-in for the promoter and promoter group. Book running lead managers are IFL Securities as well as SBI Cap. Back to you.
All right, Poly Medicure was a big mover in yesterday's trading session. QIP today. Vamakshi joins in now with all the other stocks that are in the news. Vamakshi.
Well, good morning, Mangalam. Let me first start off with high-tech pipes, going with the green for this counter, and that is because the company is looking to raise funds up to nearly 600 crores. They are considering various modes of funding, which includes QIP, FPO, rights issue, among some other combinations. The next stock on my radar is Sequence Scientific, going with the green for this one as well, after the company has received pre-qualification approval from the World Health Organization for albendazole API. This approval is in partnership with Mepro Pharmaceuticals, who has successfully developed and commercialized the chewable formulation from its WHO PQ approved plant using Sequence API. By the way, albendazole is a vital medication that is used to treat a range of parasitic infections, and Mepro's chewable formulation is the first global approval of its kind by the WHO PQ. So on the back of this development, going with the green for Sequence Scientific.
All right, got that. Amakshi, thanks very much. Let's quickly recap our list of top stocks to watch this morning. The ones that have positive news flow around them are IndusInd Bank, Nucleus Software, High-Tech Pipes and Sequence Scientific. Stocks that have negative news flow around them are Zomato, Bajaj Auto, HCL Tech, Zaggle Prepaid, Prudent Corporate Advisory and Poly Medicure. All right, so that's the stock list for the day to watch out for. With that, let's quickly move to the commodities universe. We have Manisha Gupta joining in with a roundup of all the commodity market action. Manisha, good morning. We are happy with the fall in oil prices, but you tell us, what are the other headlines? What are you focusing on?
Well, yes, it starts with the crude oil prices, though, because the second straight day of decline and 3% decline overnight clearly tells you that there are easing supply worries, the hopes of Middle East ceasefire, and the soft refinery margins all seems to be weighing onto the crude oil prices. And that's pretty much the case across commodities also. We have started Asia on a weaker note. The gold prices, which hit a 25.10 of a high, all-time high rather, in the markets yesterday, have come off, and we are trading now below $2,500 an ounce. This is because of the ceasefire conversation within the Middle East. So that has taken off some safe haven demand for gold prices. This is happening even as the dollar index is now trading at around 7-month lows, just about holding 102 in the Asian markets right now. The base metal prices, while yesterday was a great day, last week was a good one as well, but we haven't been able to hold to those kind of levels. So copper prices, after gaining to almost 2-week highs, have come off slightly. Steel prices are off its 8-year highs, but we have seen some profit taking onto this one as well. Same is the case with nickel and zinc. They were gainers in last 6 or 7 trading sessions, but today there is some profit taking or correction coming in for this too.
All right, Manisha, thank you very much for that. So oil down, but base metals broadly higher overnight. We'll take a quick commercial break here. We are back. Amnish Agarwal, Head of Research at Prabhudas Leader, will join in to discuss some fundamental aspects and individual names as well. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call. If you look at the GIFT Nifty, it's indicating a positive start. If you've just tuned in, a 50-point uptick is what we're seeing on the back of good global handover and an overnight decline in oil prices as well. Let's get stock specific now. Amnish Agarwal, who's the Head of Research at Prabhudas Leeladhar, joins in. Amnish, yesterday stock that did extremely well was Voltas, up around 5%. We've also seen positive commentary come in from consumer durables sellers, the likes of Electronic Smart India, etc. What are your thoughts on this space right now? Is there anything that you like in particular? especially given the sort of move that we've seen here already?
You see, if you look at Voltas, I think there were two big reasons for that. We had perhaps one of the harshest summers we have seen in maybe last 4 or 5 decades. And that is why the sales of ACs were very good. The volumes were very strong, and due to operating leverage, I think the margins also improved, but not to the extent it was expected. Even their EMS division, they did well. But I think at the current price, you see, this kind of it is structurally ACs are fine. There is no doubt. But having said that, the kind of extreme weather conditions which prompted the very high sales growth this year, it might not be repeated in the coming year. So I believe that at the current valuations, a lot of positives are already factored in, and the incremental returns from here on will not be very meaningful. Now, coming to your broader durable space, given the fact that your monsoons are, you can say, running fine on normal and the demand revival is there, I think the broader durable space is likely to see increased action in the coming few months.
Okay. So that's Voltas and durables. Amnish, hi, morning. Let's get your views in on the oil refiners. I mean, even yesterday, there was a nice pop on most of these stocks, IOC, BPCL, HPCL, even actually the upstream guys, because of the windfall tax cut. What is the general expectation in terms of GRMs that you have as we go forward? This morning, again, there's a positive tailwind because of the fall in oil prices, maybe a trading pop. But in general, after the first quarter, what is your takeaway and what's the view on the refiners?
Okay, so in terms of, say, GRMs, if you look at, say, past few quarters, last quarter GRMs were significantly lower than the normal levels. Now, what happens incrementally is that this quarter the GRMs are improving QOQ, and given the fact that the oil prices have shown some correction, I think there is a scope for further improvement. But this gave you some sort of a trading proper, because if you look at, say, estimates, the current estimates already factor in the GRMs, which are at a, I would say, significantly higher levels than what we have seen in 1Q of the year. So in the near term, I think there could be some, I would say, trading, you can say, kind of an opportunity, but structurally, will it lead to any earnings upgrade or something? I don't think there's a case for that.
Amrish, hi, good morning. Thanks for joining in. Just a quick word on, but what's your view? And do you have sort of active coverage or a view on metals and mining? Stocks all spiked yesterday. The metals index was up 2%. Tata Steel, Hindustan Zinc was a big mover. So steel, non-steel both did very well. All the news out of China is not all that great. One of the largest steel producers out there is saying, well, be prepared for some stress, for a longish kind of stress period. Your thoughts here, Amnish?
Yes, steel prices are actually driven by what happens in China. Now, if you look at, say, 1Q, you can say the EBITDA per ton of most of these steel companies, that was, I would say, not very great, significantly lower than the peaks. However, there is likely to be, you can say, sequential improvement in that. But if China slows down, if there is more, I would say, softness in the prices coming on the Chinese front, then I think the Indian companies won't be benefiting much. The only silver lining here has been that the raw material prices have also been relatively benign. So I think it is, again, I think at the current juncture, there could be, say, some trading proper kind of a scenario, because if China slows down and the global, you can say, the global steel prices, they come up, then I think it doesn't make the case for a very long rally in the metal stocks.
All right, Amnish, request you to hang in there. Perhaps you'll be interested to listen into this conversation that we're getting in from, the Motilal Oswal conference as well. Sachin Ashok Salvi, the CFO of Krishna Institute of Medical Sciences, joins in from the 28th Motilal Oswal Annual Global Investor Conference. It reported a steady revenue growth in the first quarter. There was a mild dip in occupancy. The average revenues per occupied bed were higher in the first quarter itself. Thanks a lot for joining in. Always a pleasure speaking with you. The first quarter occupancies were slightly lower. So the question then is, the second quarter so far, have you seen a bit of a pickup? And what are you guiding for this year when it comes to occupancies and average revenues per occupied bed?
Certainly, the second quarter we are seeing a good growth. The percentage occupancy is improving. In fact, seasonally, Q2 is always a better quarter for us. So we are seeing a good uptick in terms of occupancy in Q2. Percentage occupancy is likely to remain in the range of 50 to 60% at the year-end level. That is what our expectations are.
And this is on increased base, right? Because you have the Nasik hospital coming in as well.
Yes, so Nasik hospital was likely to commence operation in the month of July, but certainly it got delayed by about 1 month, and we are expecting to start it by 31st of August. In Nasik, we will be starting in the first phase about 100 beds. So considering this, I'm talking about the percentage occupancy which I just mentioned.
Okay. Got that. Sachin, hi. Good morning. Prashant here. So just a quick sense. I think you're adding a total of what, 2,000 beds over the next year and a half?
Yes, about 2,000 beds we are adding over the period of next 15 odd months. That includes facility at Nasik, Thane. We are coming up with 2 hospital units in Bangalore, one at Marthali in Bangalore, and the second one is near the Electronic City in Bangalore, which is about 250 bed hospital units. So about 2,000 beds we are adding over the period of next 15-18 months.
So you'll basically move up to about 5,500 beds by the end of all of it.
Yes, so currently we are operating 3,975 beds to be specific. By the end of the entire expansion, we will be at 5,500 odd beds.
And Sachin, hi, morning. All of this is, taking place, this entire expansion through your internal accruals. I mean, just give us a level of the cash on the books that you'll be left with, if at all, after this expansion is complete, and if you're looking to borrow at all.
So currently we are gross debts at around 1,200 crore. Our debt equity ratio is about 0.5:1. Some of these expansions which we are doing is out of our current accruals because the business is literally giving a cash of about 500 to 600 crore every year. We are doing some of our expansions out of our current internal accruals, and we will be raising some debts. We are ensuring that the debt equity ratio remains in the ratio of 1:1. At the end of this current expansion which we have planned, that is about 1,500, 2,000 beds which we are adding over the period of 15 odd months. Our debt equity will remain in the ratio of 1:1, and our debt would be certainly in the range of 1,600 to 1,800 crore at a gross debt level.
Okay, so just to clarify, Sachin, you're saying that your debt equity currently is at about 0.5. It will go up to about 1:1 as you go through this expansion, but it won't go above, it won't cross 1. Got that? At the peak, got that.
Cross it.
Got it. And you said that at a yearly basis, the business throws up almost 500 crores of cash. Again, if we talk, end FY25, by the time you'll be deploying some of that cash, some of those internal accruals as well, how much cash would you like to retain on the books? What are you comfortable with? Because you're doing a mix of internal accruals and debt to fund this expansion. So what's the cash right now, and how much would you want to, see it at by the end of the year?
So currently, as on 31st March 24, we were having on our books about 125 crore as cash. We will continue to maintain that cash level at the year-end financial year 25.
All right. What really stood out in your first quarter was the average revenue per occupied bed, because you are doing a lot of these high-end surgeries, etc. as well. So wanted to know, in your overall proportion, how much revenue comes in from high-end surgeries, and what's your target then on the average revenue per occupied bed? Because all of last year it was close to 32,000, and the first quarter itself it jumped all the way up to 38,000.
So the first quarter average revenue per occupied bed had improved mostly on account of optimization of our bed capacity. LOS, that is length of stay, was quite low in some of the segment. That is the only reason. It will sustain for about another 1 or 2 quarters. This is what we are anticipating. As far as our contribution from the higher end surgery is concerned, it is almost to the tune of 25-30%. and that would be certainly maintained.
All right, so 25 to 30%, ARPOBs stay around that 32 to 35,000 rupees mark. I'm just looking at rough calculations. You said you'd be close to around that 5,500 beds over the next 15 months or so. At peak of this after this expansion cycle completes, you could do revenues of what, a little over 5,000 crores? Is that a possibility? Or if you take the ARPOBs further higher, depending on how higher you take it, it comes to close to around 5,500 to 6,000 crores as well.
Certainly 5,000 or 5,500 is in the range, because most of our facilities which are coming are in the metro cities. One of our facilities which is coming in Thane, there itself the ARPOB is hovering around 50 to 55,000 for the listed players. Of our Bangalore facility, for example, Bangalore units, the ARPOB is hovering around 65,000. So currently our ARPOB is about 35,000 in some of our units. So considering that and considering the growth expansion which we are envisaging in coming years, certainly 5,000 is in range, and ARPOB is likely to improve further.
That's by FY27, likely to be about 5,500 crore on the top line?
We are anticipating it to be in financial year 26, because these newer facilities, given the market, given these are some of these are virgin markets, we are anticipating this to reach by financial year 26, if not 26, certainly in 27.
Sachin, we'll leave it there. Thank you very much for your time. Good speaking with you on the sidelines of the Motilal conference. You know, the GIFT Nifty will come up on your screen. Take a look at what that is indicating. And then we will sort of go across to Anuj, who's standing by with what he's making of the markets and the setup. Okay, I think Anuj is with us. Anuj, morning. What are you picking up?
Morning, Prashant. Well, you know, the market's been making some kind of trending moves. And yesterday's session was actually quite good after a blockbuster Friday that we had. And the reason I say that is that after a 400-point rally, the Nifty closing in green is good enough, along with the fact that the market bit was strong through the day. And almost like parallel lines, you had advanced decline, which was very strong. Now, as long as the Nifty is above the 20-day exponential moving average, the texture is buy on dips. The bank Nifty is a bit of a problem, as HDFC Bank and ICICI Bank both are sulking. And as we approach the Jackson Hole Symposium, the market will bet on dovish Fed. So that means that IT, metals, oil and gas, perhaps that could still remain the space, the go-to space. On the Nifty, the levels I'm watching out for, first support is 24,500 to 24,550. And then 24,390 to 24,425, where all the major moving averages are placed. The resistance comes in at 24,625 to 24,700, yesterday's high, and then 24,800 to 24,850. On the bank Nifty, as I said, it's struggling at 10 and 20-day exponential moving average. That's where the resistances are, 50,400 to 5,500, the 10-day moving average, and then 5750 to 5,800, the 20 and 50-day exponential moving average. The support comes in at 5,200 to 5,300, and then 49,900 to 50,000. Now, for the quote of the day, I have taken a very interesting one. It's the birthday of this author, Jacqueline Susan, and you know, the quote is, when you're climbing Mount Everest, nothing is easy. You just take one step at a time, never look back, and always keep your eyes glued to the top. It's a birthday, and it's also your birthday, Prashant. So from my side, wish you a very happy birthday, and to Shireen as well, if she's watching, happy birthday to her as well.
Well, happy birthday to Shireen as well. And Anuj, thank you very much for those wishes. Great quote, as always. And, you know, a little bit in the market, a little bit as far as some of these live lessons are concerned. We'll take a quick commercial break here. We're going to come back with our technical experts, Mitesh and Sudarshan, and we continue to run you through what you sort of need to do in terms of specific trades. That's the advice on the other side. Stay tuned. Welcome back. You're with us here on Bazaar Morning Call. We got about 10 minutes to go, 9 to go for the pre-open session. It's going to be a 40-point higher start. The global backdrop is very positive. So you've got that as a bit of a tailwind. But institutional flows, especially from FIIs, has been poor, has been lackluster. You need more and more at higher and higher levels. You need more and more in terms of absolute amounts for the market to do better. So it gets a little weighty. So you need FIIs to pull their weight as well, which they've not been doing. Mitesh Thakkar is with us with some technical trading ideas. Sudarshan will also be with us in just a bit. Mitesh, good morning. Your thoughts as we begin today's session. Is it prudent to go long on a 30-40 point gap up?
Morning, Prashant. So one, I think not on the Nifty, purely because of the fact that the Nifty will immediately run into resistances. 24,630 thereabouts is the 61.8% retracement area. There is a gap as well. So not very keen to buy the Nifty. I would be watching the Bank Nifty very, very closely. Now that's the index which has kind of, underperformed. But if you look at the last few days of data, it's had some two closings on the hourly and the 2-hourly charts around this 49,750, 800 zone. Potential of what could be a bullish reversal pattern, which is a double bottom. So I think the Bank Nifty on the upside, if it can get past 50,750, 50,800 levels, then I think, you will see a strong reversal happening in the Bank Nifty, and that could be the trigger for the Nifty as well. So watch the Bank Nifty. I would want to buy once the Bank Nifty starts trading above 50,800. Take a 150 odd point kind of a stop loss and look for 500-600 point kind of a continuation rally over the next few days.
All right, that explains your call on the indices. We also welcome Sudarshan on our show. Good morning, Sudarshan. You've been positionally long on the index, but now, as we open higher, do you think these consolidation levels are good for people to, prop up their positions right now, or maybe just stick around with whatever you have right now?
Good morning. See, the market trend is up. Now, consolidation is really an ideal location to go and add to your positions. That doesn't give us a guarantee that the market will go up, but it's the best trade in town. Now, the trade is not to buy on a gap up. Even yesterday, it was not so, and earlier also. The trade is that this market is giving us intraday dips. If you see a 75 to 100 point dip, that's a range. Then you go long, your risks have become that much less. Keep a 100 point stop loss from your entry price and stay long. If you're already long entering into today, stay there with a 100 point stop loss.
All right. Your individual stock picks?
Sure. Canfin Homes is a buy with a stop under 785. I also have two IT stocks, and IT is the sector that's doing a little better. LTI Mindtree is a buy with a stop under 53.65. Coforge is a buy with stop under 5,900. My only intraday short is Apollo Tyres, which has been consistently falling relentlessly almost day after day. So stop above 489, but primarily focus on the long positions.
All right, very close to its 200-day moving average, Apollo Tyres. We'll keep an eye out on that one. Mitesh, your stocks?
I have more of buy calls. The Gas Authority is a buy with a stop at 233.5 for targets of 250. A buy on Berger Paints with a stop at 550 for a target of around 585, 590. And BPC was a call earlier as well. Now can be bought afresh with a stop at 335. Look for targets of 360 here. And BHL is this solitary sell call. Keep a stop about 300. Look for targets of 280.
All right, gentlemen, we'll take a short break, come back. On the other side, we will have the pre-open rates for you as well. And then we'll get in some more market opinion coming in. Stay tuned to Bazaar Morning Call.
Welcome back. Well, we will start getting the pre-open rates any minute now. We also have our F&O guest joining in, so let's get a couple of F&O trades going for the day as well. Sneha Sheth, derivatives research analyst at Angel One, is with us. Sneha, good morning. So it was a range-bound session yesterday. What are you calling for today? I'm going to call either a trade on the index or individual stocks. What are you working with?
So very good morning. Yesterday, we did see a very choppy session. However, Friday's session was quite interesting, wherein we have seen a strong up move. The base has been shifted towards 24,400, 500 for now. And any move above 24,600, 650 would be interesting. So it's a market wherein any dips can be used to go long. As far as individual counters are concerned, I have a 2-buy call. So National Aluminium, this counter looks quite good at this point in time. We have seen some profit taking from the higher levels, and from the strong support zone around 163, 165, it has been rebounding. So I would recommend buying this counter with a strict stop loss of 166, and the target expected will be around 181. Apart from this, metal space was doing quite well yesterday. So I have a buy on Tata Steel. This counter was consolidating after a profit taking, and from last 2 sessions, it has been showing decent strength. So I believe we can go ahead and long Tata Steel with a strict stop loss of around 150, and the upside target would be around 162.
All right. Thank you very much for those trades. We'll come back to you for more as we go along. We're going to just sort of play out some sound bites that we got yesterday from Ramdev Agarwal of Motilal Oswal Financial Services. So we spoke with him about what they've done with this Zomato position. I mean, it's a widely owned stock. And of course, I mean, Motilal was in their funds, one of the early investors. They've trimmed some positions. We also touched base upon his views on Ola, specifically Ola and what it means for some of the other two-wheeler companies out there. Listen in.
What kind of thing we accumulated at sub-100 level after the first correction. I think quite a bit of that we have sold at a mutual fund level, but exact position I would not know as of yesterday or today. But significant trimming has happened as the prices have moved to 200 plus, and also because of risk management, when the portfolio size goes beyond 10%, regulatorily also you have to trim it, and even as per our own style of investing, we bring it down to 6-7% kind of thing. So I think all of these have led to some kind of profit booking, but my outlook for the industry still remains extremely buoyant. I would think that the best is ahead for the industry. As we go forward, recovery will pick up. I think we've seen the first quarter result. The first quarter result was fantastic, that they are clearly leader in their field. And in two-wheeler particularly, I have seen being number one is very important. So on the electric mobility, they are clearly number one, and they have very dominant share.
That's Ramdev Agarwal with perspectives on both. I mean, of course, Ola and Zomato. Amnish is still with us. Amnish, you're going to take a shot at these? What would you do if one were considering fresh investments here?
You see, Zomato's numbers have been good. It is picking up in both the businesses, that is Blinkit as well as the food delivery. And if you look at last few quarters, I think Blinkit business has added more value for the investors. So I think given the fact that they are likely to enter into new businesses, the stock remains in the positive territory for the medium term, but obviously the returns can be much more measured now. So for someone who is holding on to the stock, you can say continue to hold on. But for fresh buys, one will have to be more rational in terms of return expectations. Now, as far as Ola is concerned, I think it's you can say, classic case. In the last 10 days since its listing, the stock has more than doubled. So this usually happens when you can say the understanding about the industry is very limited. First pure EV company which has got listed. Now, in terms of profitability, we might be far away. So it might take some time, but I think it is basically due to their backward integration, battery business, etc., that the stock is commanding these valuations. So I would say it's going more on the trajectory of what we have seen with you can say IREDA a few years back. So
right.
I don't think it is going to crack down, but at the same time, I think incrementally one will have to be much sure as far as your numbers are concerned. But in terms of their product pricing, of the bike in terms of backward integration. If one has to take a bet on the pure EV play today in the market, in the OEMs, I think Ola is on the only vehicle for that.
All right, just be mindful of the float available here as well. 17% of the equity is available for trade right now. Obviously, the first tranche of post-IPO lock-in opens on September 5th. So until then, we'll keep an eye out on this stock as well. But good time to get in, a view on the metal space as well. We have Rahul Jain joining in. Rahul, there are base metals which are rallying this morning, but at the same time, there is a fair amount of concern around what took place. The Supreme Court saying that there could be retrospective royalty which will be charged by states over the last few years itself, and that took Tata Steel down in Friday's trading session. What are your thoughts on the space right now? What should one be looking at?
So on the metal side, steel is under slight pressure. We've seen price cuts happening right from March, and the price this quarter also we've seen about 1,000-1,500 rupees kind of cut, which is ongoing. Now coming on the Supreme Court deferring, there is expectation that the government may come out with a kind of a bill to defer this kind of payments, because cost will go up quite dramatically, especially for captive miners. For example, NMDC categorically stated that they will pass on whatever increase they've had to their customers. So for the steel companies, especially, the issue is quite serious, and there's expectation of some kind of leeway that they can get in future, but it's all speculative right now. And plus you have a weak pricing environment right now. For non-ferrous players, the ruling isn't as impactful, especially because the cost element on the mining to the end metal product isn't a lot. So inside the value addition is very high, so the cost impact isn't very much. The steel companies definitely will have to rework their strategy, and plus you don't have a pricing environment which is supportive currently. They have a global, especially in China, the steel production hasn't been cutting off, but the demand is off. So their exports have gone up quite sharply, which is, hurting the domestic steel producers. And domestic producers haven't been proactive in cutting prices because obviously for them the cost inflation is high, and they've announced very large capacity increases. So they have to balance between profitability as well as the capex which they're doing. So
sure.
So that is the slight issue.
So Rahul, yeah, exactly. Coming to the global picture, not just demand supply, to try and understand that for both ferrous and non-ferrous. Staying with ferrous, I mean, what you just said, this demand concern out of China, because we all know that no matter what stimulus measures they provide, the property market still seems to be in the doldrums. And I was reading that apparently the domestic steel consumption in China is a quarter of what it used to be at the peak. And therefore the higher exports that you're referring to. So given that context, what are we expecting in terms of the demand supply trends here in India? I mean, to what extent?
Actually, the demand is not an issue at all. Like if you see, most projections are between 8 and 12% growth. But thing is that the pricing is determined on the marginal producer. So Chinese, they're kind of selling at cost or below cost, which is really despite the fact that India iron ore is captive for a lot of players, and there is a huge pricing difference in terms of the landed price of iron ore and the prices what the steel players pay for. But despite that, the margins are under significant pressure, and with the price coming off recently, we could see quite weak numbers in Q2. Typically, second half is much better, but again, it is subject to a lot of conditions. In some Chinese, the export slowdown, and there is a anti-dumping duty probe which has started against Vietnam and things like that. The iron ore producers especially haven't cut prices in India. So I was just checking for NMDC, we could see another 20% kind of a price cut which they should do based on historic pricing parity. So there is cost which is not coming down as fast, but the end product.
Rahul, what's the compression in margins? Could you just quantify that? I mean, at least Q2, the here and now, what is the kind of compression in spreads that we are looking at potentially for domestic steel manufacturers?
On an average, about $20-25 lower than the first quarter. So that is the general number, because coking coal, what happens is the number varies from company to company depending upon when they have booked the coal, the imported coal. Prices for coking coal also have come down. but there is generally a lag. So typically you need to keep 1 month inventory with you, so you cannot really adjust cost very fast. And second half is generally better for the industry in terms of volumes. Now pricing is we'll have to see in terms of how things shape up in China and global factors. But it looks tough for any price increases to happen in the near term.
Okay, and that we should put that line out. NMDC 20% price cut.
So the historic parity has been about 60% discount to international prices. Currently, they're at about 45%. So just taking that, so around 1,000 rupee cut should happen in the next 1 or 2 months, depending upon when they revise, when they meet, and things like that. So in case of non-ferrous, the situation is far better.
I'll just come to non-ferrous. I'll just come to non-ferrous in a bit. I want to, for our viewers, right, the new thing, what we want to address, and the graphics will come up on your screen. So I hope I'm pronouncing this right. China Bao Steel Group Corporation. Rahul, you must have read this. So the chairman of the company, and they, by the way, produce about 7% of global steel. They said that the crisis, they're calling the crisis, will likely be longer and more difficult to endure than we expected. In the process of crossing the long and harsh winter, cash is more important than profit. This is coming in from the chairman of one of the large steel companies in China. Go on, sorry. So go on, Rahul. You want to say something?
If you see the historic pattern of how economies evolve, China is kind of way past its, the per capita that you expect.
No, I get that. Let me ask the question. Will we see duties going up here? Will we need that? I mean, if this is a prolonged situation and they're going to sort of ship out stuff because the consumption there is low, will duties need to go up here in India for protection purposes? How urgent is the need?
These duties have been introduced in the past, so it's not like a first time it's happening. Think that, it's quite ironic that the cost curve is quite low in India, but we're still not able to price the steel competitively. And which is also because the cash requirement is very huge for these companies. So if you see, we will add 20-25 million tons of capacity this year. And 20 years back, our annual production was only 30 million tons. So the scale of cash requirement is quite huge. So to balance these considerations, the government made adding tax, which I think is a temporary measure.
So this is not exactly a conducive environment to go long steel stocks, right, Rahul? Briefly.
So see, they have had a great last 3 years, obviously. So you could have a pause for a while. And so depending the pricing, the spot pricing plays a lot of crucial role in terms of how stock prices will behave in the short term. And so structurally, overall, globally there is a overhead. So you cannot expect these stocks to deliver very massively from here. But you will have stories where a lot of the smaller names are where.
That's true. That's true. In 30 seconds, in non-ferrous, what do you like? You say the situation there is much better.
Yeah, non-ferrous, the cost structures and everything are very conducive. For example, aluminium, they have their own, a lot of the companies have own alumina, own bauxite. A lot of them are getting their own coal as well. So the cost curve is in the top decile. So that actually really is very profitable at this point of time. Vedanta, Hindalco, both are looking very good. In fact, Hindalco for the first time after a very long time is looking to add capacities in India on the smelting side, on the refining side, which is very positive. So I think both these companies are, and we have only two real large non-ferrous players. Both of them are very good, actually.
All right, Vedanta and Hindalco both looking good. Rahul, a quick conversation today. Thank you for your time. Good perspective. Appreciate it here on CNBC. Sudarshan is with us with his 9-10 call. Sudarshan, what do you have?
Well, consider buying Coforge with a stop under 5,900.
Coforge. And Mitesh, what about you?
Buy on Gas Authority for targets of 250.
Okay, all right, gentlemen. Well, we have just a couple of minutes to go before trade kicks off. 3 minutes to be precise. And the pre-open is settled with about a 70-75 point sort of an up move on the Nifty. Some of the movers on the upside are BPCL, Shriram Finance, IndusInd Bank. These are the early gainers in the pre-open session. We'll talk about TCS in just a bit because there's a favorable note coming in on TCS. I think we have Rima with us for that. Yes, Rima, tell us what Nomura is saying. They're sounding quite bullish.
Well, it's Macquarie on TCS, where they've raised the target price to 5,740, and it's a sharp increase from the previous target price, which was 4,750. So near 1,000-point increase in the target price. And the key reason is the earnings remain unchanged, but the valuation multiple has gone up to 35 times FY26 PE. Earlier, they were valuing TCS at 29 times. They've also added the company to their marquee idea list. Now, the idea behind this Macquarie note stems that just about 2 weeks back, TCS had held analyst meet where they had demonstrated their investments in AI and some of the use cases. So this impressed Macquarie. So Macquarie says that TCS has created a legacy modernization framework based on AI, which means AI can now make legacy modernization cheaper with lower risk and greater accuracy. And this opens up a large market for TCS over the medium term. The company also showcased their AI-based autonomous vehicle platform with an algorithm that supports more than 50+ features. So they're just going back, zeroing in on the fact that the company makes a lot of R&D investments. TCS's R&D investments are just 1 or 1.2% of their revenues. But in absolute terms, the company spends more than $300 million per year in terms of R&D investments. They keep filing patents, and that's what makes Macquarie bullish on TCS over the medium term. They say TCS has the broadest portfolio of services and geographies, allowing for low risks and continued growth. Back to you.
Right, Rima, thank you very much for that. So that is TCS in focus. We'll see how the stock opens up on the back of that brokerage note. We've got a couple of seconds to go for market opening. We'll do, as always, look at indices, and then we'll get into individual names. Yesterday, of course, Nifty was quiet. The broader market was vibrant as ever. Market breadth was overwhelmingly positive. Small cap index ended just about under 2% higher. So there's a lot of stuff, a lot of blocks, which of course have been coming through in the market as well. First trades, what do we have? About a 0.25% gain, 24,630. The sensex is at about 80,651. So the sensex also about 1/3% higher at this point. Nifty Bank is starting at about 50,440, 50, about 0.15 higher. Slightly behind what Nifty is doing at this stage. The IT index, Friday was a big 3% day. Yesterday was positive, and today it's starting about 0.5% higher once again. So these are indices. And of course, the Nifty heat map is up on your screen. You've got about 6 odd names which are lower, but everything else is starting up in the green. 0.25%, that's about 60 points on the Nifty to begin this Tuesday.
Okay, well, let's take a look at some of the movers and shakers. On the way up, the refiners, oil refiners, BPCL again about 2.5% on the upside. It's not alone actually, even if you look at HPCL or IOC, with the fallen crude prices, these stocks are reacting fairly well. TCS is also up and about on this Macquarie note that Rima was just alluding to, about 1% higher. IndusInd Bank is the second best performing stock on the Nifty. They're looking to set up an asset management business and have the approvals in place for it. So that's a stock on the move as well. Hero Moto, Tata Motors, Eicher Motors, these are the early auto names. Bajaj Auto as well, about 0.5% on the upside. So this is the winners list. Some of the metals names like Hindalco, for instance, are up as well. On the downside, ONGC is cooling off after yesterday's big move. There's some profit taking on Cipla, on ITC, on Tata Consumer. So in general, early trends, but FMCG and pharma are a bit on the back burner. You have a lot of the other moves and shakers on the upside. 70 points higher, so pretty okay start.
Pretty okay start. In fact, it's incredible on the broader market front as well. Yesterday as well, when we started, we had about 1,700 stocks which are advancing. For about 350 stocks which are declining, the advance decline maintains its outperformance of advances versus declines. And the stock of the morning once again is Ola Electric, up 6% at open. It has now, with today's move, doubled over the IPO. So 8 sessions is all it took for the stock to double from its issue price. 76 has now turned into 154 rupees in just 8 trading sessions. So Ola Electric is one of the stocks that we'll be watching out for. Apart from that, a lot of these bulk deal related stocks are buzzing around too. So you have something like an ADF Foods. Remember, in the pre-open, there was an equity exchange of nearly 4% of the outstanding shares, and as a result of which that stock is up around 5%. Zomato, the large trade has happened at the opening tick itself. From the lower levels, the stock has seen a bit of recovery, still down by about 1/3%, or rather 2/3%, but it's recovered from the lows. In the FNO pack, among the top gainers today is Polycab. There's a favorable note coming in from UBS on the cables and wire industry. They believe that Polycab is one of the better placed stocks out here, and that stock's doing extremely well too. Though we're seeing some softness in names like Aditya Birla Fashion, Birla Soft, as well as Trent. Remember, Birla Soft did extremely well in yesterday's trading session, but has re-entered FNO band, so maybe some bit of give back is what one is seeing out there. Profit taking for names like Mazagon Dock, etc. continues, so that stock lower by about almost 3%. But by and large, it's a very strong market when it comes to the breadth of the market itself. 1,600 stocks continue to do well as against 440 stocks which are lower.
Absolutely. 4:1 advances to decline ratio. So this is looking good. And Ola is top of the charts once again. In terms of volume-led gainers, it's sort of way ahead of everything else. By a factor of 10, I think, if you just look at the value traded. So 156 or so on Ola. It's 6% in the green and holding on to the gains. You got, I think, Unicommerce, right? I think Mangala mentioned it, 8.5 higher on Unicommerce. It's a new listing.
Yep.
So that's 8.5% in the green, 246 on that one. Look at the volumes on it. 4 million shares, by the way. So it's a very large gain. Sequence Scientific is up 9% right now. Stocks at about 172. It's got very large volumes as well. Praj is starting 4% in the green. These are individual sort of SMID movers, small and mid-cap movers. Praj is up 4,781. Keytex continues its journey, 40% in 3 days. Today is the 4th day, and it's starting another 3.5% on top of it. Nucleus, I think we did mention, Nucleus is up 16%.
Buyback.
There's a buyback announcement. And, of course, it was higher, but it's still up and about. What else? Kernex is up 5, and I can go down on the sort of volume traded list, but this is it largely. High-tech, GPT Health, All Cargo. All Cargo is coming up with a 6% gain.
All Cargo has reported its July monthly update out there. They said that it's the highest ever monthly volumes that the company has reported, 6% month-on-month, 5% year-on-year. That works well for them also because, it tells you that maybe the international shipping-related, freight cost-related worries are now abating and people are looking to, increase these volumes out there. So, big positive for All Cargo Logistics. I look for a rub-off coming in on all the other shipping-related companies as well.
No, absolutely. Though, I mean, for now, in terms of shipbuilders, because they've had such a fantastic ride, Mazagon is the top volume-led loser, Mazagon Dock. 3% down. And again, volumes are through the roof for this point in the day. And then look at, GE Shipping is down 1.25%. And I think I saw Garden Reach is also down about 2.5%. Cochin Shipyard is down about 1.5%. So the shipbuilders, ship repair companies, of course, some of them like Mazagon, Garden Reach, etc., are actually even Cochin, depend on the defense. These are quasi-defense on the naval side. They are seeing some amount of profit booking. RVNL, ONGC, Moripin Laboratories, Oil India are some of the others which are seeing some knocks.
Zomato, with the trade having been done, stock's still down about 1% or so. Otherwise, it's the railway complex, really, the railway favorites. Most of them are down. RVNL, IRFC, RailTel, a lot of them down. Actually, even some of the PSU banks. I mean, in general, there's some profit taking on the PSU universe, UCO Bank, a couple of others on the way down as well on the PSU side. So that's how it's playing out. But otherwise, the mid-cap index up 0.25% in step with the Nifty, holding on to gains of about 50-odd points.
I wonder what's up with matrimony. That's the stock.
Even yesterday, yes.
Shadi season. I don't know whether it's Shadi season or not because they don't benefit as much from Shadi season as they benefit from searching season. And for searching, I don't think there is any. Yeah, but
it was 20%
but
yesterday.
That can happen every time, right? you don't need to. There's no season for that. But definitely a big mover. Everyone's talking about the.
Survey was highlighting.
This is 20% yesterday by close, and on top of that, it's a 6.5% up move. So
26% in the last two trading sessions.
It's the general sort of rub-off of the festivity. And by the way, now it starts, it goes on all the way till the end of the year. Early.
So to start searching now, if you have to have a winter wedding like that, right?
All right, Venugopal Gare is with us, Managing Director and Head of Research India at Bernstein. Venu has been, of course, expressing his wonder at how strong and how hard the market has been rallying through his notes. Some of them really sharp and pointedly expressing his views. Venu, so you're coming back after a while, so why don't you tell us what you're making of things before we really delve into some of the finer aspects of, PEs and earnings estimates, etc. Go on.
Thanks, Prashant. The market resilience has primarily been pretty interesting. Now, it's interesting because the fundamental reality is that you're not really seeing any earnings growth acceleration. And more importantly, you're not even seeing earnings upgrades. The only difference is that we're still in a decent macro cycle. Earnings growth are decent, even if they're slower than what we actually saw in the previous 2 years. Now, the reality is that whatever the framework be, it's very tough to justify stocks across the board from a valuation standpoint. And it's actually very tough to justify them even from long-term measures. So what is essentially happening at this juncture is the broader macro strength, which I think is fairly visible for the next few years, is ensuring that the domestic flows sort of remains resilient and actually been very strong. It's not just sort of bringing up or pushing up markets. It's also ensuring that a lot of the broader IPOs that you're seeing and stake sales that you're seeing are also getting digested. So that is a fundamental reality at this juncture. So somewhere down the line, one still has to participate in these markets. You can't be really off these markets. So people like us also figure out creative and imaginative mechanisms to ensure that we still remain buy on certain stocks and push some ideas. So that's where we are.
Right. Very interesting there, because, I was just looking at your note, and it's exactly what you're saying right now. Most investors appeared uncomfortable with market levels, but investing continues with cash levels not being raised. What's interesting is that you've, dissected this phase-wise. The phase one is where there is phase of denial, where a strong macro and earnings outlook drives a re-rating. That has happened. Towards the end, you then start to see acceptance of these valuations. That's phase two. Rational investing still prevails. Then you're talking about the invincibility phase, where public market investors start to think like venture funds, and people, the era of imagination commences. Do you reckon we're in phase three, and what typically happens after phase three?
So that is something which, out of a bout of frustration, we had put across in a recent report to sort of timeline the sort of a market cycle. And actually, I've seen that in the past as well. We're all like pretty old hands at the market. I think we are just about heading into phase three. Phase two and phase three, I do still see some degree of rational voices in the market. But this juncture, early stage phase three, and I think this phase three could last for a while. And what happens after a phase three is very clear that you primarily reach a situation of a bubble, which when pricked, but you need an external catalyst to prick it, then there is a collapse. And I have a slightly different view on the collapse this time, because one of the perspectives that I have at this juncture is the fact that broadly, there is a willingness to, sort of give high Ps to stocks rather than high earnings, right? So what it means is earnings upgrades are not necessarily the driver for the market. So when the collapse happens, you're not going to see a massive earnings-led collapse. It's going to be just valuations tempering down materially. So that's basically what we see post phase three.
Okay. So, Venu, so what's the sense from here on? And if indeed we are going to get into a period of, muted performance or underperformance, then is this the time to sort of keep your powder dry? And what's the strategy with which you're going? Should people be sort of booking some profits, raising cash in the portfolio and get ready to redeploy? What's the advice?
In fact, the advice is to do everything. So it's a very interesting advice, because the way we are approaching it is that all of us are searching for a big negative catalyst to bring down the markets. Now, in the absence of any big negative catalyst at this juncture, the idea is to participate through various mechanisms. So what we're doing is that we are taking an approach that certain sectors which look still reasonable and may not necessarily be high growth sectors, we need to perhaps have some positions there. Second thing is, when I say those sectors are sectors like financials, right, which haven't really performed, where growth is not necessarily very high, but valuations are fine. Similar is the case of ID services. The second sort of a bucket for us is essentially look at high growth sectors, which are very high PE, but where there is potential for, as I call it as a new term, non-linearity. where high growth can last for slightly longer, or they get new opportunities because they're in certain sectors which offer you new opportunities, and suddenly you actually see that growth, let's say 30%, remaining at 30% for another year. So we are actually sort of in that bucket of those stocks that we essentially push. It is not just high growth. It is high growth with non-linearity, which is what we push as a second bucket, in terms of the stocks that we would look at. And the third aspect is, yes, wherever you feel uncomfortable with the growth valuation equation, start to trim down a bit. It's a combination of all that we choose when we build a portfolio as well.
And by the way, Venu has, I think recently, not that recent as well, but he's got a small cap portfolio as well, right? I think you got names like Dixon, Keynes, Muthoot was the latest addition, and I think there's one more there as part of that grouping.
Sona Comstar, yeah.
Sona Comstar, yes, that one. Just something you were talking about earlier, Venu, I want to just sort of ask you to explain that a little bit more. You're saying whenever the market kind of starts to come off, it won't be anything big. It's just valuations which will start to taper off, right? Now, what you're implying is that earnings estimates are not, typically at this phase of the market, earnings estimates become a little unrealistic, which is what you're saying is that has not happened. It's P multiples which have been taken through the roof. So it's a little different from what we've seen in prior cycles, right? It's especially at this phase of the market. So when we say, for example, we put out post-quarter earnings reviews and we say, well, earnings have not, in some cases, beaten, but they're not even beating those sort of moderate earnings expectations anymore. It's not just, the bar is not very high in that sense because estimates are not crazy. Estimates are reasonable. It's P's which are through the roof. Just explain that, yeah.
Yeah, Prashant, the interesting point that you noticed, so I'll tell you an interesting story around this. Let's say 15 years back, previous cycle, which is perhaps the first mean cycle that we saw, and this sort of investment community was also smaller and perhaps just starting to understand how to professionally look at equity markets, used to be very embarrassed to put 20x Ps or 25x Ps on stocks. That's a fundamental reality. We have tried doing that during that phase in the peak of the cycle, and we used to get slammed, both by investors who used to actually question us on the rationale of a high P such as 20-25x. At the same time, even trying to internally approve these sort of valuation metrics used to be very difficult. So what the market used to do in that embarrassment of not being able to put very high Ps, they used to take up earnings growth. So the previous cycle, what happened is, as we moved up all the way to FY 07-08, the earnings became frothy because that was the only way to justify your stock price targets or stock prices. And then when the collapse happened for various factors, cyclical factors and other factors that we all already know, there was pretty massive earnings downgrades that we saw at that point of time. Now, the difference with this time is that people are a bit more liberal. I don't feel embarrassed putting 100x P rate on stocks. Nobody questions me. People feel happy about it. And the same is the situation 50, 70, 80x P. So now we don't really need to keep very high earnings for the next 2 years. The other opportunity that analysts are using is using FY28, FY29. These creative mechanisms used to be slammed earlier. So
sure, Venu. Venu, yeah, I hear you, completely hear you and get your point that there are different ways of justifying the rise in stock prices, right? But I have a very simple fundamental question. And, they say that markets can stay irrational far longer than someone can stay liquid. So now if you're saying it's the beginning of phase 3, this phase of invincibility, the question is that given the extent of domestic liquidity, just the amount of money pumping through the system, could this continue for a whole while longer? And so therefore, should one participate knowing fully well this is perhaps a phase of irrationality we are in? Who's to say this turns tomorrow? Because, standing in front of a wall of money is like standing in front of a speeding train, isn't it?
Well, that's right. And that's the reason why our broader philosophy is to stay invested, but then alter your portfolio in such a way that you don't end up taking risk on low quality companies. Right? That's like a tricky thing. We're okay with high valuation companies as long as they're high quality. or have a visibility for growth. So that's the only difference. And number two, remember that when liquidity is there, liquidity finds a way to get sucked, which primarily means you're going to see an acceleration in fundraising cycle as well. And not all of the fundraising will be high quality.
Okay. Just to pull on that earlier thread, Venu, you said that 100p, nobody's embarrassed anymore of putting 100p, right? And you were saying using creative methods like using FY28, FY29 earnings estimates. So if you want to finish that point, or if you've already done, my question is it also because people are, in terms of their holdings, we say that, well, people are becoming long-term investors, right? Nothing matters. But actually, you will only use FY28 and FY29 if you don't really care about FY28 and FY29. If you are confident that you will be able to justify something so that you can make money very quickly. In 3-4 months, you're able to make a lot of money, which has been happening in many stocks. Just respond to that.
Yeah, that's right. See, investment horizons over the years that I've seen last 20, 25 odd years has essentially shortened quite materially. So the focus usually is on the near term in terms of earnings momentum and growth, right? So you really don't know which stocks which are generating 30% growth today will actually be 0% growth 4 years from now. But it's a classic extrapolation that you can do and then easily justify a target price today, right? Which primarily is a factor which is being done across the board, across investor base, across sell-side analysts, right? So that becomes easy to then justify sort of creating that narrative around story. So that's again another factor, right? If you're very near-term looking, then you don't really look at what is priced in for the long term. We typically publish a reverse DCF trying to explain that, hey, you can't have 25% growth for the next 30 years for this particular stock, right? Even if it has 35% growth today. So these questions are usually less asked when your horizons are very small in terms of investments.
Venu, just one last question. Sorry, I'm just completely now changing track, but very interesting sort of, way to look at things and what is going on. Putting some historical context into it as well. Elections, we are into election season, right? And some are saying, well, general elections was barely a speed bump, so why should state elections matter? Others are saying, well, especially a big state like Maharashtra does matter. In a month and a half, we'll be into it. And the ruling party seems to be on the back foot, clear back foot, at least right now, and things may change. Just are you getting any questions from investors on this stuff at all?
Yeah, so earlier state elections used to be not focused much, but actually we're getting a lot of questions these days on this because I think it is more to do with the fact that if the mandate state to state turns weaker for the ruling government, then what does it mean with respect to broader thinking around subsidy allocations or new subsidy schemes? I think this government has done an excellent job with respect to managing the budget fairly well. They did increase subsidies, but to an extent it was still within the broader mechanisms of fiscal deficit reduction. But then it did come at the cost of not being able to increase capex beyond what was earlier thought. So, right. So the market is weighing between capex versus subsidies and how that goes over the next 12 to 18 months. So that's why they're focusing a bit more on this time.
Venu, we'll leave it there. Thank you very much for joining us. Great speaking with you. Appreciate your time here on CNBC TV18. Well, I think from the sidelines of the Motilal Oswal 20th Annual Global Investor Conference, our colleague Nimesh Shah caught up with Sundaraman Ramamurthy, Managing Director and CEO at the Bombay Stock Exchange. Exchanges, of course, are right at the heart of this big bull market that we are seeing. He began by asking Mr. Ramamurthy about the draft paper from SEBI on the F&O segment as the deadline for seeking public comments ends today. Listen in to what he had to say on the paper and, of course, on the company's outlook for scaling volumes going forward. Take a look.
There are some views in the country, across the country in some places, that the volumes in equity derivatives market in India are slightly very high, and there are retail participants who are losing money, and there is a crowded volume on expiry days. So the regulatory intervention is to sort of address these concerns. And naturally and necessarily, therefore, they are meant to have an impact on the volumes and the participation levels.
Sure. Have you heard from the regulators so far on what the thought process is
what kind of data has been asked by the exchanges to submit as far as the volumes in the derivatives is concerned, which has been a bit of a concern for a lot of politicians, government officials, as well as regulators.
So the regulatory process in India has always been a process of co-creation. So before the entire draft paper came into circulation for public comment, SEBI had an expert working group where significantly large amount of data pertaining to various aspects of derivatives trading were discussed. Post that, the outcome of the expert working group was taken to the Secondary Market Advisory Committee, post which the paper is published. So tomorrow is the last day for public to provide comments on the paper. Our understanding is that regulators will collate all the necessary, all the comments, and based on which they will decide which one will go, which will not go, how modified it will go, and all that stuff. And after that, they will have their own internal approval process, post which the final circular will come out.
Sure. So, any deadlines, sir, in terms of timelines on by when you expect the final circular to come from regulator?
On the final outcome, I don't have the deadline, but the public comment tomorrow is the deadline.
Sure, sure. Sir, a lot of analysts believe that removal of BankX can impact the EPS for BSE by 10%. Is that a fair assessment? And what is your thought process in terms of whether BankX can get removed by the regulators?
First, 2-3 points here. I do not know what is the impact on EPS because the MIIs, we work on a very different pedestal in terms of how do we service the investors and how do we service the market. And the regulatory effect is not to remove an index. The regulatory effect is to say you should not have more than one weekly expiry. So BankX, if it is not the index which is for weekly expiry, because regulators have talked about one benchmark index. Benchmark means it should be only sensex. So by that interpretation, BankX will not get removed. It will become a monthly expiry.
Got it. But the other way to look at is that in that scenario, BSE will actually benefit because the other exchanges far more indices which are in the FNO. If those was removed and it's only monthly, as you explained for BankX, this will mean that a lot of volumes can shift to the BSE sensex. Is that a fair way to look at?
No, the way we are looking at BSE is this. As you know, we just very recently started this product. The way we are benchmarking ourselves is against ourselves. Like if yesterday I am performing X, how do I increase it to Y? If yesterday I had one product, how do I increase it to multiple products? So honestly, that is the way we are benchmarking. So going forward, what we will do is, we will be striving hard to create monthly volumes, more monthly products, and therefore we are already venturing on investing into technology, infrastructure, people, etc.
Sure. So in that case, what is the market share currently for BSE in the FNO market? And what's the aspiration goal or the number that you're looking at in FY25?
When people ask me about market share in derivatives, I tell them it is 100%. I'll tell you why. Because if there are same products between two exchanges, it is fair to put a market share. When the products are unique, how do you club all the unique products together and compute a market share? So I typically jokingly say my market share is 100% in my own products. But having said that, currently I understand out of the total contracts traded, the volume traded, BSE is trading 20% in overall. We have not put ourselves a target in terms of value here because we have unique products. We have always been putting ourselves a target in terms of number of products that we have, number of market participants who trade with us. If you recall, we started with hardly 8-10 people. Today we have around 400 plus people who have registered with us and who trade regularly. We want more people to come in. We want more investors to come in, more FPIs to come in. That is the way we are measuring our success.
Spoke about the FNO market, but what about the cash segment? Even there, it's been lacking to the competitor, but there has been some initiatives that you have already done. if you can talk about the cash segment, what the BSE market share currently is, and what are the things that you are looking to do or add in that space?
Very valuable question. If you recall, when we started, we had around 5 to 6% market share. Today, we are having around 7 to 8%, sometimes 9% market share in the equities market. But more than the percentage, the base itself has grown in a big way. Compared to around 6,000 odd crores on a per day basis, we do around 9,000 odd crores on a per day basis now. One of the most important, or rather two of the most important points to note there is, the capability to do product differentiation in equities is very limited. So what we can do is only service differentiation, which we are already doing. The second is lack of institutional participation in equity segment of BSE. So traditionally, the FPAs never used to trade other than block deals at BSE. Block deals, they used to come to us because of the inherent advantages BSE had been providing for a long time now. In the secondary market normal segment, the participation was not happening from FPAs mainly because if their brokers, they don't give instructions to the brokers to go to which exchange. But typically brokers used to punch in one exchange because at the end of the day, FPAs required a single contract note. They didn't want for a single order multiple contract notes. So this was a problem in existence. Fortunately, this has been rectified now. SEBI has made it mandatory. It's mandatory now for both the exchanges to provide in both the segments a single contract note for institutional participants. It has to come into work from October. So we are putting all our efforts to ensure the custodians and others are fully geared up for this change. Once this happens, we think that we will be able to attract some amount of FPA volumes along with it institutional volumes. So that should improve our situation in equities market.
Sure. So the other big growth engine for you has been the Star MF. That platform has done really well for BSE. Any plans to monetize some value or unlock some value in Star MF going forward?
If by question of monetization you feel whether we will be selling it across, no, the approval has been given to the exchange, so it is part and parcel of the exchange. There are other areas where we can improve our performance in mutual funds. You may be aware that we have already embarked our journey on version 2 of our system, and it is going live. It's already gone live on a test basis. On a full-fledged basis, we will be completing that by end of this year and sunsetting the older system. I'm sure you're aware already on a monthly basis we are touching new highs in terms of volume processing. We process around 5.25 crores of orders per month now. Out of the 3.8 crores is actually SIPs. We are very bullish on mutual fund segment because compared to the entire population and various numbers and paradigms, I think we have not even scratched the surface in respect of mutual funds.
All right, that is the top management of the Bombay Stock Exchange sounding quite bullish on the mutual fund business, looking to grow more institutional participation and looking at more monthly contracts, more product innovation on the F&O side to take their market share higher from the present 20%. Well, with that, we'll take a quick note with the news that the market's actually looking good. 93 points up on the Nifty now, so it's been pretty resilient. And some of the life insurer stocks, we should look at them. HDFC Life, SBI Life, that's where the buying is very, very clear this morning. So these are the major up movers. And then there's TCS, obviously, because of positive brokerage commentary. That stock's been doing fairly well. So that's the market for now. We do need to take a quick break. Come back on the other side, and we'll be connecting with Vinod Kumar Gupta, MD of Dollar Industries, as well as Ramesh Agarwal, ED at Rupa and Company, to talk about the trends ahead, consumer trends, the expectations from the second half, and how business is looking.
Welcome back. There's been a big up move in the market right now. The Nifty is up around 100 odd points. It's led by the Nifty Bank. There's no weakness in the Nifty Bank, and that's positive for the Nifty, because apart from the Nifty Bank, we're seeing a strong support coming in from the IT pack as well. So all guns blazing right now. So the Nifty Bank has moved to the high point of trade, just about 200 points away from that 50,850 sort of resistance mark that everyone's looking at. IT, no problems there. TCS leading the way. We have a note coming in from a brokerage, Macquarie, and that stocks moved to the high point with a gain of almost 1.5%. And we have a bunch of other stocks doing extremely well. Axis Bank, for instance, has led the Nifty Bank higher too. We'll keep an eye out on what happens with HDFC Bank. That too has now crossed its 50-day moving average. 1638 is where HDFC Bank is at right now. The 50-day moving average on that one is 1635. Remember, had crossed the 20-day or seen support at the 20-day moving average. Above that 50-day moving average, let's see if it sees further buying from here on itself. The second half will have the Nifty Financial Services expiry play out. Let's talk about an interesting theme now. Remember yesterday here, we were talking about, the correlation between economic growth and the sales of underwear in an index that Alan Greenspan followed called the Underwear Index. Well, while we talk about its impact on the economy, etc., let's talk about how the industry itself is doing. So we have a special discussion lined up for you. Dollar Industries is, joining us today. And along with that, it's Rupa as well. Both of them saw a fairly steady quarter this time around. Revenue contribution for both these companies from the modern trade and new channels remained, robust, whereas we did see from Lowe's a big improvement in the EBITDA as well. But what's the way ahead? How's demand? We do have with us Vinod Kumar Gupta of Dollar Industries and Ramesh Agarwal of Rupa joining in as well. Thanks a lot, gentlemen, for joining in. Let's start this with Ramesh. The first quarter obviously saw some bit of improvement in demand, but the question is, how's the remainder of this year looking? And more so on the EBITDA margin front as well, because last couple of years you were in high teens, closer to 20%. Then you saw a big decline to low single digits, and thereafter you're closing in on that double-digit mark. So in terms of growth this year and margins, what are your thoughts?
Growth this year has been primarily been driven by volume because there is a price resistance. So we anticipate and we are seeing a growth in the demand for athleisure, thermal and ladies wear segment. So there we see a very robust growth. And when you say about EBITDA margins, yes, you are right. The EBITDA margins from 20% it has gone down, but we hopefully will maintain the EBITDA margin in 2 digits, so between 10 and 11% for this year.
And what about you, sir? We have the management of Dollar Industries as well with us. Mr. Gupta?
Yeah, good morning. As regards the EBITDA margin you are speaking, we are trying to maintain in between 11 to 12% for the current fiscal year. It was down in the previous years for some other reasons because of the price adjustments and market going up and down. But now the market seems to be steady and flourishing. And in terms of demand, we understand that there is a consumption recovery both for innerwear and the outerwear. And this is quite visible also in the current market. Sentiments have also been boosted up by the sales kicking off through the quick commerce.
Okay. Gentlemen, more on the local market in just a bit, but I'm just wondering how both of you are looking at your big companies in your segments, right? And how you're looking at exports. I think, Mr. Agarwal, for you, and correct me if I'm wrong, I think exports are still in single digits in terms of total revenues. Dollar is also exporting to many countries and markets. So if you gentlemen could start by telling us what the percentage of exports is now, and then also describe to us the opportunity. I mean, we all know what's happening in our neighborhood, right? Bangladesh. Now, I'm guessing that there is some business to be sort of taken up from there. Tell us if that's possible, not possible, and whether Bangladesh and what's happening there, if that has any positive rub-off on your export opportunity. Mr. Gupta, if you could start, tell us exports as a percentage of revenue and what's the opportunity? What's the scale up?
If you look at the exports is, of course, we are not improving much in terms of exports. The total exports from our company side is hardly 4% of the total revenue. And we are struggling still in the market for getting a big jump. If you look at the Bangladesh is primarily into exports of outer garments. They are not into the inner government. So whatever scene is there in the Bangladesh, that is not going to even create opportunity for us, or not even create something negative for the Indian products into the exports. And
okay,
we
fair
are trying,
enough.
Pardon?
No, I was asking, sir, because of, I mean, a lot of you folks are in the athleisure segment, right? Or outerwear as a category is something that most companies are also trying to now grow in, because that's where the margins are as well. But yes, please do complete your point. What is the scale up in exports that you see at Dollar Industries? And then we'll get Mr. Agarwal's take.
Yeah, in terms of exports, of course, athleisure is a big market. But then right now, from our side, from Dollar point of view, we are struggling in the market in terms of getting cheap products coming from China and Bangladesh into the market. The price is a big factor there. We are still struggling and trying to sell athleisure into the market. But we are hopeful of maintaining 10 to 12% growth in terms of exports this year. And we are trying to also enter into deep of African markets where the Indian products are well accepted by the country.
Okay, got it. Mr. Agarwal, sir, same questions to you. The export opportunity that you see ahead.
Our base in export is very small compared to our turnover. It's around 4-5%. But we see a good traction because we are actively pursuing exports. And when you say about Bangladesh market, yes, it will take time. But yeah, we are getting some inquiries from organized players, because Bangladesh supplies mostly to organized big names. So we have a factory ready, and it's a fully compliant factory. And we see good inquiries, and it will take time, yeah, but that opportunity is there. And apart from that, for our Rupa brand, which we are exporting, we see a good, the last 2 years were not so good, but this year we see a good traction, and we hopefully will be able to grow at around 20% in exports, more than 20%.
You will grow about 20% in exports. You know, if I look at the construct of the industry, it's interesting. From the listed end of things itself, if you club the revenues of both Rupa and Dollar, you get the revenues, the annual revenues of what Lux Industries posts. And if you club the revenues of Rupa, Dollar and Lux, you get the annual revenues of what someone like a Page Industries posts as well. I wanted your thoughts on the construct of the industry right now. You know, we start with Mr. Gupta. How much is unorganized? How much is organized? At what rate are the two growing? And in the organized part itself, what's your share of revenue coming in from premium? How much is coming in from non-premium? Because at the premium end, there is a fair amount of competition as well, right? I mean, you have the ABFRL group, Van Heusen doing well. You have Page doing extremely well there as well, alongside competition coming in from newer players like Trent, etc. in the innerwear space too, and Arvind Fashion. So, if you could give us a little on the construct of the industry and how you see your growth out there.
Yeah, if you look at the, we are into three category of products: super premium, mid premium, and then the economy range. The economy range constitutes almost 48% of the total revenue, and the mid premium is around 40-41% of the total sales. So if you look at the structure of the organized versus the unorganized market, as far as the study goes, it is 1/3 for the organized sector and the 2/3 is for the unorganized sector. But then the way the industry is moving now, we are taking a big chunk of revenue out of the unorganized market into the organized market. That conversion is taking place, but then it is being converting at a very slow speed. It is not at a faster speed. But the way the modern retail, the way the e-commerce is taking into the market, we understand that the share of the organized sector will keep on increasing over the taking share from the unorganized markets.
Right. Mr. Agarwal, would you have any sense of the market share for you, your peers, and how is that moving?
We're taking market share from both the upper segment and both the unorganized segment. We have brands in all the segments, like we have a economy brand, we have the mid-premium brand and a premium brand. So what we are in the sense, like our mid-premium and economy, are the share in the turnover is almost equal. So that advantage we have, and we see growth in both the segments. So that means we will be taking share from the unorganized market and as well as the larger players then. than us.
Where does the market share stand for you?
There is no data as such, but based on the turnover, I mean, it's very difficult to gauge. There is no data. There is no published data on that. So.
Okay. All right, gentlemen. So let's wind this down by getting individual sort of outlook on your respective businesses as well. Both of you have reported margin expansion in the first quarter gone by. So, Mr. Gupta, if we could start with you, give us a sense of what we can expect in terms of top line growth, because the first quarter, the top line was a little flat, though the margin improved, and you're saying that you're looking to hold margins at the current 11 to 12% trajectory. What about revenue growth this year, full year?
In terms of revenue growth, if you talk of both volume and value, we aspire to grow at a CAGR rate of 10 to 12% each year, and to reach the turnover of 2,000 crores by the end of March 26. And that's our target. And if you look at the figure of the previous year, 23-24, you will also see that we did a good jump in terms of both volume and value. And that pace we are going to maintain in the current financial year and the year to come.
And Mr. Agarwal, what's your volume growth target? Also, you mentioned that you're looking to grow margins to at least hit double digits this year on a full year basis, right?
Yeah.
Also, just the volume and top line projections, please.
See, there's a pressure on prices, as I said. So volume growth will be more than the value growth. So value growth we see to grow at around 15%, and volume would be higher, so maybe 18-19% volume growth.
Okay. All right, gentlemen, we will leave it there. Thank you very much for important insights into, the innerwear and also the outerwear, businesses that you are building up. Thanks for joining in. Good to know. And that's pretty interesting that I think, though it's a very small part of the business, but they're saying that some inquiries by larger organized players who are right now sourcing from Bangladesh, some of those inquiries are beginning to come to companies like Rupa. Rupa at least mentioned that they're getting some initial conversations going. But with that, let's get back to the market. The market's been surging all the way. I mean, it's actually a nice pickup, 128 points now. 24,700 is on the board. Mitesh, so the bulls are charging down. They've begun their charge, shall we say. What are the trades?
Yes, so two things here, Survi. One, the Bank Nifty has picked up and is now at that breakout level of 50,800, 750 zone, which is what I indicated. Let's hope it clears that. Once that happens, the Bank Nifty can gain about 51,400, and in good case 51,800, which is a 1,000-point rally, and that should prop the Nifty up as well. So stay on the long side. The stocks that I have, LTTS I think is a buy, and Kotak Bank is a buy. LTTS I would recommend buying with a stop at 52.90 for targets of 5,500. And after a long time, Kotak Bank is on a buy side trade. Keep a stop below 79 here. Look for targets of 1850.
Okay, all right. Mitesh, thank you for that. By the way, one more set of stocks, Mitesh, if I can sort of put this to you. Mazgaon is down 5% now. So there's a bit of a breakdown. Cochin is down about 3%, and Garden Reach is down about 4% as well. Anything strikes a chord here in terms of any trade one can take? Yeah.
Prashant, see, you can short these cash stocks. I think they are now going through a slightly bigger correction. I'm looking at a target of around 42.85 to about, and in the worst case scenario, 41.50 for Mazgaon Dock. Similarly, Cochin, if you look at the charts, I think while there is some support which is at about levels of 2,100, is maybe showing a pattern of breaking below that. If that happens, I think this decline should extend, and this correction could see the stock price head to sub 1,900 levels. So I think this is very clearly a pattern of stocks which have done extremely well, now going through a slightly bigger pullback.
Right. Just a quick word on two more names. Actually, one more name. Because Ola, of course, doesn't have price history. Ola is down in the day now. So it was up about 6-7% at the day's highest point. But I think for the first time since its listing, it's actually now lower. 1%, 1.5%, hardly anything. 3/4, 0.5% or so. But of course, volumes are really one of the highest. But it's settling down a little bit after the non-stop breathless rally. Just wanted your view, Mitesh, on Edelweiss. Again, it's almost into 3 digits now. Stocks at about 98, 7% higher.
Yeah, Prashant, I think a very good breakout is taking place over here on the long-term charts. It did a good range of about 85 to about 60 for 3 to 4 months, and then now is breaking above that. I think the target on the upside is minimum is 110, but looking at the long-term charts, good chance that I think the stock might head towards 120 odd levels. So 110, 120 could be two trading targets here. Add it slowly. It's already had a good run up. So buy partly here, get a 4-5 point dip, add there, and I think keep a stop below 18 weeks.
All right. Thank you for joining in, Mitesh, with your trades. The market is doing extremely well, 24,700 on the Nifty. And we do have Interglobe Aviation doing extremely well as well, one of the beneficiaries of lower crude. But speaking about crude, we take a short break now. Come back on the other side. We focus on the commodities markets. Manisha joins in.
Welcome back. So it's a good morning for equities. Let's see what's happening in the world of commodities. We have Manisha with us in the studios now. Manisha, good morning once again. So what do you have your eye on?
So I'm looking at the crude oil prices because the major price moves have come in for this one. We've seen near 3% of decline in the overnight markets. And with that, when you look at the last 1 week, it has been a 6% of a cut that you can see in case of crude prices. Well, a few reasons why the crude prices are under pressure. One, the supply concerns really seem to be going away. And this is as there are hopes of a Middle East ceasefire coming in. There are conversations happening right now in Cairo, Egypt, and that perhaps has taken some premium of those prices. The other thing is about the China demand concerns. All the economic data that we have seen coming from China has been on the weaker side. The Chinese demand itself has been weaker. And when you look at the Chinese exports, especially when it comes to gasoline, well, they declined by 35% in the month of July on an year-on-year basis. Apart from that, it is also about the soft refinery margins. The heating oil prices also are trading at a 14-month lows. So when you add all of that together, if you look at the last 1 week itself, we have seen very sharp decline come in for the prices. Crude oil, as I was telling you, is down 6.5% in the previous week. We also have seen 5 to 6% of decline come in for gasoline and heating oil, and the gas prices also have declined by more than a percentage point there. Important to watch crude because the latest PPAC data shows that when it comes to self-sufficiency in sense of crude for the Indian markets, well, that has actually seen a decline from almost 12.2% in the previous year. The first 4 months show 11.7% of self-sufficiency for the Indian markets. And the next table will also show you on what is the crude oil import dependence that India has. Well, it was at around 87.8% of what we were importing as per our requirements, but that is gone to a higher 88.3% in sense of, and this is of course for the first 4 months of this year. And as you can see, it clearly has been rising. India imported 84% of its requirement in FY21, 85 to 87, and we only seem to be going higher there. So very important to look at the crude oil prices in the international markets, and of course a decline today does augur well.
All right, thanks very much, Manisha, for that. That's the commodity space and focus. And of course, I mean, the next sector is also heavily a commodity play, which is the cable and wire segment. UBS has put out a note with their thoughts on the space and why it looks good, their top ideas and more. Upasana is here with details of what UBS is saying. Upasana, over to you.
Well, that's correct. UBS has written a note on cables and wires segment. It has initiated a buy rating on KI Industries with a target price of 6,150 and a buy rating on Polycab with a target price of 8,550 per share. It believes that the segment is poised to grow 2x the GDP growth in FY24 to FY30. And it expects that the current $8 billion segment is set to grow to $20 billion in FY30, and market share of the top 5 companies will certainly rise. It believes that the shifting in global supply chain will lift the export revenue from $2 billion in FY24 to as high as $5 billion in FY30. It also expects a revenue CAGR of 20% and EBITDA CAGR of 25% from FY24 to FY28 due to multiple triggers such as robust demand, operating leverage, growing market share, and robust export penetration of the companies. Now, coming to KEI Industries, the brokerage says that it is a consistent earnings compounder and only pure play on cables and wires. The company offers multiple triggers such as growth for cables and wires is set to sustain for a longer period of time, scope for market share gains in branded housing, wires and cables, and also export ramp up. Now, coming to Polycab, the brokerage says that it is a cyclical growth champion, beneficiary of a long-term electrification growth. It has a significant room to grow its total addressable revenue share, and FMEG consumer pull is the key for the company. It also expects better than expected domestic volume growth, market share gains, and also export ramp up are some of the key near-term triggers, is what the brokerage has highlighted. So all in all, we are seeing a positive note written by UBS on cables and wire companies.
Okay, all right, Upasana, thank you very much for that. We will take a break on that note. On the other side, we are back with our special segment, The Economy. Lata today will connect with Mahesh Vyas, MD and CEO of CMIE, and K. Ravichandran, Chief Ratings Officer at ICRA, to decode if a private corporate capex cycle is indeed picking up.